What's going on? It's Ryan here, CEO and head quant at Happy Trader. Today's video is going to be for the absolute beginner on the call options. Doesn't matter if you subscribe to Happy Trader or not. We are going to be using Happy Trader as an example, but this is going to be a beginner's video on how to trade the call option. And this will cater to just about an absolute beginner. So if you're not an absolute beginner, this video is probably not for you. If you want to do a little bit of brushing up, I will get into some more advanced concepts toward the end of the video, but we're just going to be looking at Tesla as our example stock, and we're going to be looking at the call side of the options chain. So the first thing with a call option is you're going to be dealing with the options chain. So you're going to have your expiration date. That's going to be your first big thing that you're going to need to pick. And in our case, for this example, we're going to be doing more of a swing trade, so 47 days to expiration. And the next thing that we're going to do is just set up an example. Let's just say we're not even going to look at what date and time this signal popped up, but let's say we get an uptrend signal on Happy Trader. And again, you don't need to be a subscriber or use Happy Trader for this. It could potentially help you. A disclaimer, this is not financial advice. This is for educational purposes only. So what we're going to do is just look at the call option and kind of dissect what it is in the context of we have a market thesis. Let's say we have a signaling platform like Happy Trader, and we get an uptrend signal on the 45-minute chart, which is going to represent a swing trade that could span 1 to several days, okay? But could be a decent trade, right? So how do we want to use a call option? Why would we use a call option? What is a call option? So a call option is going to be a leveraged instrument traded on the options chain, and it's going to be something on this side of the options chain. So you have the call side over here, you have the put side over here. We're only dealing with this side, right? So if we think the market's going up and we have a thesis, let's say we want to buy an at the money or slightly in the money call option, right? The at or slightly in the money strike price is going to be the 185 in this case. And you can see because this is 189. So this is actually slightly in the money, where the 190 is slightly out of the money. And you can see that when you're in the money, you have intrinsic value. And when you're out of the money, you don't. You have extrinsic value, right? So there's actual value when you're in the money. And there's not actual value. There's just speculative premium, which is extrinsic value, which is baked into the options chain, the pricing of the option. Now, Tesla is one of the more volatile ones. Now, what's premium? Premium is what you pay for an option, and you're going to pay, let's say, $1,300 for this option here. And you can see this one is slightly out of the money. It's actually Tesla's at 189. This is at 190, and it's 47 days to expiration. So if you think that Tesla is going to go up and that's your thesis, maybe you could buy a call option 47 days out. That gives you a little bit of time. Now, one thing to note about call options is they're leveraged. So what you will be effectively needing to do and what you will be doing is if you buy this call option, you'll be controlling about 55 shares of Tesla. So if you buy a call option at this delta, all the way at 150, so this is referred to as a deep in the money call option, you're going to be controlling about 91 cents on the dollar, 91 shares of Tesla. And if you go super, super deep in the money, you're almost controlling the entire thing, but still for less than it would cost to buy Tesla outright. So that's where you can do okay buying these in the money options. Now, there's some other more advanced things that you can do. If you buy more in the money, let's say 47 days out, you can also sell call options, some of these bad boys right here, out of the money on a smaller time frame, like a 5-day expiry. So you could go to, let's say here, you can go to a different strike, you can go to the same strike, and you can sell options against your option. So there's a lot of versatility. This call option in its own is a tool that many use on its own with nothing else on the sell side and the buy side to speculate on the market. And there's several ways to trade it. So the most basic way is just to buy a call option. So when you buy a call option, you're going to pay the premium and you have a capped risk. And you can see what the graph looks like here. The max loss is going to be what you paid for the option, okay? So now you can see here, at the option expiry. These are maybe some instruments that you may want to potentially take profit on. But you can see that theoretical P&L down here goes up nicely. So if you buy one that's at the money or slightly in the money, let's say we buy one that's slightly in the money, the 185, you can see that we get an even better risk reward profile there. So the benefit of buying a call option, there's a couple things. Like I said, you get to pick how long out in time your call option is going to be. You get to control what the delta is of that option. And if that option goes your way, since it's leverage, you end up actually automatically controlling more. Now, conversely, if you lose on that option, let's say you buy this one here, and the price goes down instead, you're going to end up in a scenario where the options chain shifts and you might only be controlling 27 shares of Tesla or 27 cents on the dollar, right? So that's going to be where delta is very important. So the two most important Greeks, in my opinion, are delta and theta. So delta is going to be the amount of stock equivalent, or the amount of pennies on the dollar per stock, per 100 shares of stock that you're going to control per one contract. Okay, so don't forget, when we're buying these leveraged instruments, they're going to be contracts. So you can see here, quantity one, quantity two, you can scale these things up, right? You can buy as many as you need. And you can see that when you buy a call option, you can see there on the theoretical P&L, if we buy a lot more call options, there's a lot more upside, right? Potentially. If you're wrong, you have the downside, right? But the good thing about buying a call option is that your downside is limited to what premium you pay, right? So that's great. Now, the other cool thing about a call option is they tend to be pretty liquid, meaning you're able to get in and out of them for a pretty tight spread. And that's going to be this right here. So let's back out of this and we're going to go into the bid-ask spread. You can see there's a very small spread here, 15 and 25. It's a 10-cent spread or a $10 spread, because remember, there's 100 share control on each call option purchased. So if we're talking about the difference between 10 cents, 30 and 40 in this case, we're actually talking about $10. Now, there's a couple things that you can do. There's, like I said, the ability to sell options against bought options. The poor man's covered call is another video that we're going to be doing. That's slightly more advanced, but just buying the call option, you need to decide carefully how you're going to do it. Now, some people, if they're anticipating a huge move in the market, they're going to perhaps buy out of the money. But something to take note of is if delta is how much stock you're controlling based on the option being in the money or out of the money, based on the delta, the theta is going to represent a sort of a formula of how volatile the stock is, meaning Tesla is one of the most volatile, if not like the most volatile. So what happens is if you buy an out of the money call option, there's no intrinsic value, meaning there's no actual value until it goes in the money. And if it's in the money and then the stock drops, you can see you can just lose all that intrinsic value pretty quickly, right? If we start to go down. So some folks like to buy these out of the monies, and a lot of folks do it during earnings. Now, why don't I do it during earnings? The thing is, these premiums go up running into earnings, and the options chain is baked in with this theta element. Theta is going to be your time decay, right? At the option expiry, if you buy an option and it does not expire in the money, meaning you don't have any intrinsic value at the end of the day when that option expires, you are going to end up in a scenario where you could have paid 1,300 for an option for 190, but the stock's at 189, but then it drops down to 140 or whatever, or even 165 at the time of that 47-day expiry. Never quite gets in the money. You don't sell the option. Let's say it goes in the money, you don't sell it, you hold it, and then the price goes down. Now you're going to be in a scenario where you paid that premium, but that premium dries up. If we go to a nearer expiration, you can see theta really is in play. So the further out you go, there's more theta, there's more premium, there's more meat on the bone, like I like to say for our happy trader videos. If you get to pick your date of expiration, you get to pick your strike price in conjunction or in relevance to the stock price, and that's going to give you control over a lot more theoretical shares of the market. Now, me personally, I like to trade slightly out of the money. I believe that Happy Trader gives an edge. So if I have an uptrend thesis, I'm going to maybe take a trade a little bit out of the money, but knowing that trade's out of the money and that it has a very good chance of not ending up with any intrinsic value at the end of the day, at the expiry, even 47 days out. If this falls into a territory where the options change shifts and now this 5 it goes up to this 11, I might just sell that call, right? So for a profit and just get out of that position. I no longer have the right but not the obligation to buy 100 shares of stock at this strike price, right? So 215 or 210 or 205, whatever out of the money I buy. Same goes for in the money. You can exercise at any time options that you buy. So if you're on the sell side, I'm going to make this one a little bit shorter. You do have to watch your risk. So let's say that let's go back to Happy Trader and let's reset the chart view here. And let's say that on the 45-minute chart, we have a downtrend signal. You can see it is starting to drop. We already had a little bit of a move there, quite a bit of a move for Tesla, but we have a downtrend signal. How can you use a call option if it's for the market going up? I'll show you how if you're not already aware. So how can you use a call option? One way to do it is by using a call vertical spread. Selling just a straight up call is going to introduce infinite risk. So chances are your account, if you're a new trader, isn't going to be like if we just bring up this one option here and we go to the snapshot analysis and we're just selling one, let's say one option, doesn't matter what strike, your max loss is infinite. Now, the best way, in my opinion, to trade when you're doing this type of thing, let's get rid of this here. Let's go to a call vertical. You can see it's called a call vertical, even though we're looking on the bearish side, right? So we have to inverse the strikes and we're going to just stick to whatever. We'll just go to March 24th. Doesn't matter, right? We're just showing you what the call option is when you want to use it in a bearish way. So you can see this line here is where we're at with the price of the option. And you can see that if it ends up below that, you're going to collect that amount of profit. If it ends up above it, you're going to collect max loss. And that's going to be just a simplistic video on how to trade the call option. My name's Ryan from Happy Trader, CEO and head quant. Have a great day and happy trading.